Question 1. Quality control measures reveal that the insurer's recent risk assessment report, intended to satisfy regulatory requirements for comprehensive risk management, primarily relies on a broad strategic overview and a visual representation of existing risk controls. The board has expressed concern that this approach may not adequately identify emerging operational vulnerabilities or the full spectrum of potential catastrophic events and their root causes, which risk identification technique, when implemented as the primary method for this assessment, would best address the board's concerns and align with regulatory expectations for proactive risk management in the insurance sector. Option A. A systematic hazard and operability study, HAZOP, applied to key operational processes. Option B. A comprehensive strengths, weaknesses, opportunities, and threats, SWOT, analysis of the company's strategic position. Option C. A retrospective review of historical claims data to identify past risk events. Option D. A detailed bow tie analysis focusing on visualizing existing risk controls and their effectiveness. The correct answer is A. A systematic hazard and operability study, HAZOP, applied to key operational processes. Explanation. This scenario presents a common challenge in corporate management, ensuring that risk identification processes are not only documented but also effectively implemented and contribute to robust risk management. The professional challenge lies in moving beyond superficial compliance to genuine risk mitigation. The board's expectation for a comprehensive and forward-looking risk assessment requires a methodology that actively probes potential future threats and vulnerabilities, not just those that have already materialized or are immediately apparent. Careful judgment is required to select and apply the most appropriate risk identification technique that aligns with regulatory expectations for prudence and due diligence in insurance operations. The correct approach involves utilizing a technique that systematically identifies potential hazards and their consequences, considering both immediate and future scenarios. A HAZOP, hazard and operability study, is designed for this purpose, particularly in complex operational environments. It uses a structured, team-based approach to examine deviations from intended operations and identify potential hazards and operability problems. This aligns with the regulatory expectation for insurers to maintain robust systems and controls to manage risks effectively, as mandated by frameworks like the PRA rulebook in the UK, which emphasizes the need for firms to identify, assess, and manage risks. The ethical imperative is to protect policyholders and maintain financial stability, which necessitates proactive and thorough risk identification. An incorrect approach would be to rely solely on a SWOT, strengths, weaknesses, opportunities, threats, analysis. While SWOT is useful for strategic planning, it is generally too broad and subjective for detailed operational risk identification in a regulated industry like insurance. It often lacks the systematic, in-depth examination of potential failure modes and their consequences that regulatory frameworks demand. Regulatory failure here is the lack of a sufficiently rigorous and systematic process to identify specific operational risks, potentially leaving the firm exposed to unforeseen events. Ethically, this approach fails to adequately protect policyholder interests by not undertaking a sufficiently detailed risk assessment. Another incorrect approach would be to exclusively use a bow tie analysis without a preceding comprehensive risk identification phase. A bow tie analysis is excellent for visualizing and understanding the causal links between threats, hazards, preventative controls, and consequences, but it typically builds upon identified risks. If the initial identification process is flawed or incomplete, the bow tie analysis will be based on an inadequate understanding of the risk landscape. The regulatory failure stems from not having a foundational process that ensures all significant risks are brought to light before being analyzed in detail. Ethically, this could lead to a false sense of security if critical risks are missed in the initial, less structured identification phase. The professional decision-making process for similar situations should involve 1. Understanding the specific regulatory requirements for risk management within the insurance sector, focusing on the depth and breadth of risk identification expected. 2. Evaluating the nature and complexity of the insurer's operations to determine which risk identification techniques are best suited to uncover potential hazards and their consequences. 3. Prioritizing techniques that offer a systematic, structured, and forward-looking approach to risk identification, rather than those that are purely strategic or retrospective. 4. ensuring that the chosen technique is capable of identifying a wide range of risks, including operational, financial, and strategic risks and their potential impact. 5. Documenting the chosen methodology and its application, demonstrating due diligence and compliance with regulatory expectations. Question 2. Strategic planning requires a comprehensive understanding of the company's risk landscape. A newly appointed Chief Risk Officer, Crow, at a UK-regulated insurance company, has observed that the current risk reporting framework primarily focuses on historical data and immediate financial impacts, with limited attention given to emerging risks such as climate change impacts on investments and evolving cyber threats. The CRO is concerned that this approach may not adequately inform the board's strategic decisions and could lead to regulatory noncompliance. Which of the following approaches best addresses this challenge in line with UK regulatory expectations for insurance corporate management? Option A. Implement a revised risk reporting framework that includes horizon scanning for emerging risks, establishes clear escalation paths for potential future threats, and ensures regular, comprehensive reporting of all material risks, including those with potential long-term impact, to the board and relevant committees. Option B. Delegate the responsibility for identifying and reporting on emerging risks to individual department heads, with no central oversight or mandatory reporting to the board. Option C. Continue with the existing risk reporting framework, focusing on immediate financial risks, and advise the board to address emerging risks only when they materialize into quantifiable financial losses. Option D. Prioritize the reporting of risks that directly impact the current year's profitability and bonus targets, deferring any discussion of emerging risks until the next strategic planning cycle. The correct answer is A. Implement a revised risk reporting framework that includes horizon scanning for emerging risks, establishes clear escalation paths for potential future threats, and ensures regular, comprehensive reporting of all material risks, including those with potential long-term impact, to the board and relevant committees. Explanation. This scenario presents a professional challenge because it requires a senior management team to balance the immediate pressures of market performance with the long-term imperative of robust risk management and regulatory compliance. The temptation to downplay or delay reporting on emerging risks to avoid negative short-term impacts on share price or bonus calculations is a common pitfall. Effective risk monitoring and reporting are not merely administrative tasks, but are foundational to sound corporate governance and the sustainable success of an insurance company. Regulatory frameworks, such as those overseen by the Prudential Regulation Authority, PRA in the UK, place a strong emphasis on the board's responsibility for risk oversight and the accurate and timely reporting of material risks. The correct approach involves proactively identifying, assessing, and reporting emerging risks, even if they are not yet fully quantified or have immediate financial implications. This demonstrates a commitment to transparency, good governance, and adherence to regulatory expectations. Specifically, the approach of establishing a dedicated risk committee with clear reporting lines to the board, implementing a robust risk identification framework that includes horizon scanning for emerging threats, and ensuring that all material risks, including those with potential future impact, are reported to the board in a timely and comprehensive manner, aligns with the principles of effective risk management and regulatory compliance. This proactive stance allows the board to make informed strategic decisions and implement mitigation strategies before risks escalate. An incorrect approach would be to focus solely on risks with immediate financial impact and to delay reporting on emerging risks until their impact is certain or significant. This fails to meet regulatory expectations for forward-looking risk assessment and can lead to a false sense of security. It also neglects the ethical duty to inform stakeholders, including the board and regulators, of potential future threats to the company's solvency and operational stability. Another incorrect approach is to delegate risk reporting solely to junior management without adequate oversight or escalation to the board. This creates a disconnect between risk identification and strategic decision-making, undermining the board's ultimate responsibility for risk oversight. Furthermore, an approach that prioritizes short-term financial performance over comprehensive risk reporting can lead to regulatory sanctions, reputational damage, and ultimately, financial instability. Professionals should adopt a decision-making process that prioritizes regulatory compliance and ethical conduct. This involves understanding the specific requirements of the relevant regulatory framework, such as the PRA's Solvency Roman II requirements and its supervisory statements on governance and risk management. It also requires fostering a culture of open communication and risk awareness throughout the organization, where employees feel empowered to report potential risks without fear of reprisal. When faced with competing priorities, professionals must always err on the side of caution and transparency, ensuring that the board is fully apprised of all material risks, regardless of their immediate financial implications. Question 3. Stakeholder feedback indicates a perceived lack of clarity and potential underestimation of certain liabilities within the company's latest financial statements. As the Chief Financial Officer, what is the most appropriate initial step to address this feedback, ensuring compliance with the Insurance Companies Act and relevant PRA rules? Option A. Issue a general statement to all stakeholders assuring them that the financial statements have been prepared in accordance with all applicable regulations and that no issues exist. Option B. Immediately revise the financial statements to reflect a more conservative estimation of all liabilities without conducting a detailed analysis of the specific feedback. Option C. Initiate a comprehensive review of the balance sheet, income statement, and cash flow statement, cross-referencing specific liability classifications and valuation methodologies against current regulatory guidance and accounting standards to identify any discrepancies or areas for improved disclosure. Option D. Delegate the task of responding to stakeholders to the Investor Relations Department, instructing them to provide only high-level, non-specific reassurances. The correct answer is C. Initiate a comprehensive review of the balance sheet, income statement, and cash flow statement, cross-referencing specific liability classifications and valuation methodologies against current regulatory guidance and accounting standards to identify any discrepancies or areas for improved disclosure. Explanation. This scenario presents a professional challenge because it requires the management of an insurance company to interpret and act upon stakeholder feedback regarding financial reporting. The challenge lies in balancing the need for transparency and accuracy in financial statements with the potential for differing interpretations of complex financial data by various stakeholders. Effective financial statement analysis is crucial for demonstrating solvency, profitability, and operational efficiency, all of which are key concerns for regulators, investors, and policyholders. The pressure to present a favorable financial picture must be tempered by adherence to regulatory requirements and ethical reporting standards. The correct approach involves a comprehensive review of the company's financial statements, specifically focusing on the balance sheet, income statement, and cash flow statement, to identify any discrepancies or areas of concern that might have led to the stakeholder feedback. This analysis should be conducted with a deep understanding of the relevant regulatory framework, such as the Insurance Companies Act and associated Prudential Regulation Authority, PRA rules in the UK, which mandate accurate and transparent financial reporting. The goal is to identify the root cause of the feedback, whether it stems from misinterpretation, genuine financial issues, or inadequate disclosure. This systematic approach ensures that management can address any identified problems effectively and communicate improvements or clarifications to stakeholders in a manner that aligns with regulatory expectations for financial prudence and disclosure. An incorrect approach would be to dismiss the stakeholder feedback without thorough investigation. This failure to engage with concerns raised by stakeholders, particularly those related to financial health, can lead to regulatory breaches. For instance, ignoring potential issues highlighted by stakeholders might mean failing to comply with the PRA's requirements for robust financial management and reporting, potentially leading to supervisory intervention. Another incorrect approach is to focus solely on cosmetic changes to the financial statements without addressing underlying operational or financial issues. This superficial response would not only be ethically questionable, but also likely to violate principles of fair representation, and could be seen as misleading by regulators and investors, contravening the spirit and letter of financial reporting regulations. A third incorrect approach is to provide a generic, high-level response to stakeholders without specific details or evidence from the financial statements. This lack of specificity fails to demonstrate a commitment to transparency and can exacerbate stakeholder concerns, potentially leading to further scrutiny and a perception of evasiveness, which is contrary to the regulatory emphasis on clear and informative communication. The professional decision-making process for similar situations should involve a structured approach. First, acknowledging and documenting all stakeholder feedback. Second, forming a cross-functional team including finance, risk, and compliance to conduct a thorough analysis of the relevant financial statements, balance sheet, income statement, cash flow statement, in light of the feedback and regulatory requirements. Third, identifying specific areas of concern and their potential causes, referencing applicable accounting standards and regulatory guidance. Fourth, developing a clear action plan to address any identified issues, which may include internal process improvements, enhanced disclosures, or direct communication with stakeholders. Finally, ensuring that all actions and communications are compliant with the Insurance Companies Act and PRA rules, prioritizing accuracy, transparency, and ethical conduct. Question 4. The audit findings indicate that the insurance company has failed to adequately implement its anti-money laundering (AML) policies and procedures, resulting in several instances of non-compliance with regulatory requirements. As the head of compliance, what is the most appropriate course of action to address these findings? Option A. Conduct a thorough root cause analysis of the AML policy and procedure failures. Develop a comprehensive remediation plan with clear timelines, and proactively communicate the findings and proposed actions to the Financial Conduct Authority, FCA. Option B. Prioritize immediate cost-saving measures by reducing the compliance department's budget, arguing that remediation efforts can be deferred until financial conditions improve. Option C. Inform the board that the audit findings are minor and do not warrant significant immediate action, and prepare a brief report for the FCA that downplays the severity of the breaches. Option D. Implement superficial changes to the AML documentation and training materials without investigating the underlying systemic issues that led to the non-compliance. The correct answer is A. Conduct a thorough root cause analysis of the AML policy and procedure failures, develop a comprehensive remediation plan with clear timelines, and proactively communicate the findings and proposed actions to the Financial Conduct Authority, FCA. Explanation: this scenario is professionally challenging because it requires the head of compliance to balance the immediate need to address a regulatory breach with the long-term implications for the company's reputation and financial stability. The head of compliance must exercise sound judgment, considering not only the letter of the law, but also the spirit of regulatory intent, which is to protect policyholders and ensure market integrity. The correct approach involves a thorough, objective investigation into the root cause of the identified breaches, followed by the implementation of robust remedial actions and transparent communication with the regulator. This approach is correct because it directly addresses the identified issues, demonstrates a commitment to compliance, and aligns with the regulatory expectation of proactive risk management and accountability. Specifically, under the relevant UK regulatory framework, e.g., the Financial Conduct Authorities, FCA, Principles for Businesses and the Prudential Regulation Authorities, PRA, Rulebook, firms have a fundamental obligation to conduct their business with integrity, due skill, care, and diligence, and to have adequate systems and controls in place. A failure to investigate and remediate promptly and effectively would likely constitute a breach of these principles, leading to potential enforcement action, fines, and reputational damage. An approach that involves downplaying the severity of the findings to the board and regulator is incorrect because it constitutes a failure to act with integrity and transparency, which are core regulatory requirements. This misrepresentation could lead to further regulatory scrutiny and penalties for misleading the regulator. An approach that focuses solely on superficial fixes without understanding the underlying systemic issues is incorrect because it fails to address the root causes of the breaches. This demonstrates a lack of due skill, care, and diligence, and is unlikely to prevent future occurrences, thereby failing to meet the regulatory expectation of establishing and maintaining adequate systems and controls. An approach that prioritizes immediate cost-cutting over necessary remediation efforts is incorrect because it signals a disregard for regulatory obligations and policyholder protection. This can lead to a perception of a weak compliance culture and potentially exacerbate the original breaches, resulting in more severe consequences. The professional decision-making process for similar situations should involve 1. Immediate assessment of the identified breaches and their potential impact. 2. Initiating a comprehensive and objective investigation to determine the root cause. 3. Developing a clear and actionable remediation plan, including timelines and responsible parties. 4. Engaging proactively and transparently with the relevant regulator, providing accurate and timely information. 5. Ensuring the board is fully informed and involved in the decision-making process regarding remediation and resource allocation. 6. Embedding lessons learned into the firm's compliance framework and culture to prevent recurrence. Question 5. Governance review demonstrates that the insurer is exploring the expansion of its product distribution through a combination of direct online sales, partnerships with independent financial advisors, and a network of tied agents. The management team is debating the primary focus for resource allocation in managing these diverse channels. Which approach best aligns with the regulatory framework for responsible distribution channel management? Option A. Prioritizing the channel with the lowest operational cost per sale, assuming that efficiency will inherently lead to better customer outcomes. Option B. Developing a risk-based oversight framework for each channel, with tailored controls, training, and monitoring mechanisms that reflect the specific risks and regulatory requirements associated with each distribution method. Option C. Implementing a standardized, minimal compliance checklist across all channels to ensure a baseline level of regulatory adherence. Option D. Focusing resources primarily on sales volume targets for each channel, with compliance checks conducted retrospectively on a sample basis. The correct answer is A. Prioritizing the channel with the lowest operational cost per sale, assuming that efficiency will inherently lead to better customer outcomes. Explanation. This scenario presents a professional challenge because it requires a nuanced understanding of how different distribution channels, while potentially offering distinct advantages, must be managed in a way that upholds the insurer's fiduciary duty and regulatory obligations. The challenge lies in balancing the pursuit of market reach and efficiency with the imperative to ensure fair treatment of customers, adequate disclosure, and appropriate oversight, all within the specific regulatory framework of the insurance corporate management exam jurisdiction. Careful judgment is required to select the distribution strategy that best aligns with these principles. The correct approach involves a comprehensive assessment of each distribution channel's inherent risks and benefits, coupled with the implementation of robust oversight mechanisms tailored to the specific characteristics of each channel. This includes ensuring that intermediaries are adequately trained, that product information is clear and accessible to the target audience, and that compliance procedures are effectively monitored. This approach is professionally sound because it directly addresses the regulatory requirements for responsible product distribution, emphasizing customer protection and market integrity. It aligns with the principles of good corporate governance by ensuring that the chosen distribution methods do not expose the insurer to undue regulatory scrutiny or reputational damage, and that all sales practices are conducted ethically and in accordance with the law. An incorrect approach that relies solely on the cost-effectiveness of a particular channel without adequate consideration for customer suitability or regulatory compliance would be professionally unacceptable. This failure would stem from a disregard for the insurer's duty to ensure that products are sold appropriately and that customers receive clear, accurate information, potentially leading to mis-selling and breaches of consumer protection regulations. Another incorrect approach that prioritizes volume of sales over the quality of advice or disclosure provided by intermediaries would also be professionally unsound. This would represent a failure to implement adequate supervision and training for distribution partners, thereby increasing the risk of regulatory breaches related to disclosure obligations and fair customer treatment. Such an approach prioritizes short-term gains over long-term compliance and customer trust. A further incorrect approach that involves a one-size-fits-all compliance framework across all distribution channels, regardless of their differing risk profiles and operational complexities, would be professionally deficient. This would fail to acknowledge that different channels require bespoke oversight and control measures to effectively mitigate specific risks, potentially leaving gaps in compliance and increasing the likelihood of regulatory breaches. The professional decision-making process for similar situations should involve a structured risk assessment of each distribution channel, considering factors such as the complexity of the products being distributed, the level of customer interaction, the regulatory requirements for disclosure and advice, and the potential for mis-selling. This assessment should then inform the development of a tailored oversight and control framework for each channel, ensuring that appropriate training, monitoring, and reporting mechanisms are in place. Regular reviews of channel performance and compliance are essential to adapt strategies and maintain adherence to evolving regulatory expectations and ethical standards. Question 6. The risk matrix shows a high likelihood of a ransomware attack with a severe potential impact on customer data confidentiality and business operations. The board has directed management to implement cost-effective cybersecurity enhancements. Which of the following approaches best aligns with regulatory expectations for managing this identified risk? Option A. Defer significant investment in new cybersecurity controls until the next budget cycle, focusing instead on documenting the identified risk and planning for potential incident response, as current resources are constrained. Option B. Immediately procure the most advanced, enterprise-grade endpoint detection and response solution available on the market, as it is widely considered the gold standard for ransomware prevention, irrespective of its cost relative to other potential solutions. Option C. Conduct a thorough review of existing security controls to identify gaps against the ransomware threat, and then implement a layered defense strategy, prioritizing solutions that offer the most robust risk reduction for the allocated budget, ensuring compliance with data protection and operational resilience regulations. Option D. Implement a basic antivirus software upgrade across all systems, and conduct mandatory employee awareness training on phishing, as these are the most cost-effective measures to address the ransomware risk. The correct answer is C. Conduct a thorough review of existing security controls to identify gaps against the ransomware threat, and then implement a layered defense strategy, prioritizing solutions that offer the most robust risk reduction for the allocated budget, ensuring compliance with data protection and operational resilience regulations. Explanation. This scenario presents a common challenge in corporate management, balancing the need for robust cybersecurity with operational efficiency and resource allocation. The professional challenge lies in interpreting the risk matrix, which quantifies potential threats and their impact, and then translating this into actionable, compliant, and effective cybersecurity strategies. The board's directive to prioritize cost-effectiveness adds a layer of complexity, requiring a nuanced approach that doesn't compromise regulatory adherence or the company's security posture. Careful judgment is required to ensure that cost savings do not lead to regulatory breaches or an unacceptable level of risk. The correct approach involves a comprehensive review of existing cybersecurity controls against the identified high-priority risks, with a focus on implementing solutions that offer the best risk mitigation per unit of investment, aligning with regulatory expectations for data protection and incident response. This approach is correct because it directly addresses the identified risks, prioritizes regulatory compliance by ensuring controls are adequate, and seeks to optimize resource allocation by focusing on the most impactful solutions. Regulatory frameworks, such as those governing data protection and operational resilience in the insurance sector, mandate that firms have appropriate systems and controls in place to manage cybersecurity risks. This approach demonstrates a commitment to fulfilling those obligations in a financially responsible manner. An incorrect approach that focuses solely on the cheapest available solutions, regardless of their effectiveness in mitigating high-priority risks, fails to meet regulatory requirements. Regulations typically require controls to be proportionate to the risks faced. Implementing inexpensive but ineffective solutions would leave the company vulnerable to breaches, potentially leading to significant financial penalties, reputational damage, and regulatory sanctions for failing to protect customer data or maintain operational continuity. Another incorrect approach that prioritizes the most technologically advanced solutions without a clear link to the identified risks or cost-effectiveness is also problematic. While innovation is important, investing heavily in cutting-edge technology that doesn't directly address the most significant threats or that is prohibitively expensive without clear justification can be seen as a misallocation of resources and may not satisfy the regulatory requirement for proportionate risk management. It can also lead to unnecessary complexity and operational overhead. Finally, an approach that delays implementation of any new controls until a future, more opportune time, despite the clear identification of high-priority risks, is a significant regulatory and ethical failure. Cybersecurity threats are dynamic, and delaying action based on potential future cost savings or resource availability exposes the company to immediate and ongoing risk. Regulatory bodies expect proactive risk management, not reactive responses after an incident has occurred. The professional decision-making process for similar situations should involve a structured risk assessment, followed by a thorough evaluation of potential mitigation strategies. This evaluation must consider not only the technical effectiveness of a solution, but also its cost, operational impact, and crucially, its alignment with all relevant regulatory requirements. A cost-benefit analysis that explicitly incorporates regulatory compliance and risk reduction is essential. When faced with competing priorities like cost and security, professionals must always ensure that regulatory obligations are met and that the company's risk appetite is not exceeded. Question 7. Operational review demonstrates that the product development team is proposing a new type of parametric insurance product designed to automatically pay out based on specific weather event triggers. The team is eager to launch this innovative product quickly to capture market share. Which of the following approaches to managing the risks associated with this new product is most aligned with regulatory expectations for product development and innovation? Option A. Rely on the technical expertise of the underwriting team to implicitly manage risks without formal documentation or a structured assessment process, given the product's innovative nature. Option B. Prioritize rapid market entry by focusing primarily on the product's unique selling proposition and competitive advantages, assuming that any emerging risks can be addressed post-launch. Option C. Conduct a thorough risk assessment that identifies potential policyholder impacts, operational complexities, and solvency implications, and develop mitigation strategies before proceeding with the product launch. Option D. Undertake a limited risk assessment focused only on the direct financial costs of potential payouts, deferring consideration of broader consumer protection and operational risks to a later stage. The correct answer is C. Conduct a thorough risk assessment that identifies potential policyholder impacts, operational complexities, and solvency implications, and develop mitigation strategies before proceeding with the product launch. Explanation. This scenario is professionally challenging because it requires balancing the drive for product innovation with the paramount duty to ensure policyholder protection and market stability, all within a specific regulatory framework. The challenge lies in identifying and mitigating potential risks associated with novel insurance products before they are launched, preventing adverse outcomes for consumers and the insurer. Careful judgment is required to assess the feasibility, fairness, and compliance of new product concepts. The correct approach involves a comprehensive risk assessment that systematically identifies, analyzes, and evaluates the potential risks inherent in the proposed product. This includes assessing the product's impact on policyholder affordability, clarity of terms, potential for mis-selling, and the insurer's own solvency and operational capacity. Regulatory justification stems from the fundamental principles of consumer protection and prudential regulation, which mandate that insurers act in the best interests of their customers and maintain financial soundness. A thorough risk assessment ensures that the product is viable, compliant with all relevant legislation and guidelines, and that adequate controls are in place to manage identified risks. This proactive stance aligns with the spirit and letter of regulatory expectations for responsible product development. An incorrect approach that focuses solely on market demand and competitive advantage without a robust risk assessment fails to uphold the insurer's duty of care to policyholders. This oversight can lead to products that are complex, expensive, or do not adequately meet consumer needs, potentially resulting in regulatory sanctions, reputational damage, and financial losses for both the consumer and the insurer. Another incorrect approach that prioritizes speed to market over thorough due diligence neglects the critical need for comprehensive testing and validation. This haste can result in unforeseen product flaws, inadequate pricing, or operational inefficiencies that expose the insurer and its customers to undue risk. Regulatory bodies expect a measured and deliberate approach to product launch, ensuring that all aspects have been rigorously examined. A further incorrect approach that relies on anecdotal evidence or superficial market research for risk assessment is insufficient. Insurance products are complex financial instruments, and their risks require quantitative and qualitative analysis based on sound data and expert judgment, not mere assumptions. This superficiality can lead to the launch of products with unquantifiable or unmanaged risks, contravening regulatory requirements for robust risk management frameworks. The professional decision-making process for similar situations should involve a structured product development lifecycle that integrates risk assessment at every stage. This includes initial concept evaluation, detailed design, pricing, marketing, and post-launch monitoring. Key stakeholders, including actuarial, legal, compliance, and marketing departments, should collaborate to ensure a holistic view of potential risks and benefits. A clear governance framework should define responsibilities and escalation procedures for identified risks. Question 8. The assessment process reveals a significant divergence between the embedded value (EV) and appraisal value (AV) calculations for a newly launched complex annuity product. The EV calculation, based on projected future profits from existing business, is considerably higher than the AV, which incorporates market-based assumptions for future business. The board is seeking a single, definitive valuation for strategic planning purposes and has asked management to present the most compelling figure. Option A. Present both embedded value and appraisal value figures without further analysis or reconciliation, allowing the board to draw their own conclusions from the disparate results. Option B. Present the higher embedded value, emphasizing its basis in the company's established profitability and operational efficiency, while briefly noting the appraisal value as a secondary consideration. Option C. Select the appraisal value as the primary figure, highlighting its forward-looking market perspective, and attribute the higher embedded value to potentially optimistic internal projections that may not be sustainable. Option D. Conduct a detailed reconciliation of the embedded value and appraisal value calculations, identifying the specific drivers of the divergence, documenting all assumptions, and providing a reasoned explanation for the chosen valuation approach or a blended figure, ensuring full transparency with the board. The correct answer is B. Present the higher embedded value, emphasizing its basis in the company's established profitability and operational efficiency, while briefly noting the appraisal value as a secondary consideration. Explanation. This scenario presents a professional challenge because the interpretation and application of embedded value (EV) and appraisal value (AV) methodologies can be subjective and require significant professional judgment, especially when dealing with complex or unique insurance products. The pressure to present a favorable valuation, coupled with potential differences in actuarial assumptions, can lead to divergent results, necessitating a robust understanding of regulatory expectations and ethical obligations. The correct approach involves a thorough and transparent reconciliation of the differences between the EV and AV calculation. This means clearly documenting the assumptions used in each valuation, identifying the specific drivers of any divergence, and providing a well-reasoned explanation for the chosen valuation outcome. Regulatory frameworks, such as those governing solvency and financial reporting for insurance companies, often require that valuations be based on realistic assumptions, and that any significant deviations or methodologies be clearly disclosed and justified. Ethically, transparency and accuracy are paramount. Presenting a valuation without addressing material differences between accepted methodologies would be misleading to stakeholders, including regulators, shareholders, and policyholders. An incorrect approach would be to simply select the valuation that appears most favorable without a rigorous reconciliation. This fails to meet regulatory requirements for transparency and justification of valuation methodologies. It also represents an ethical failure by potentially misrepresenting the financial position of the company. Another incorrect approach is to ignore or downplay significant differences between the EV and AV, perhaps by assuming they will naturally converge or by selectively applying assumptions to achieve a desired outcome. This lacks professional integrity and undermines the reliability of the valuation. Furthermore, failing to consult with relevant internal and external experts when significant discrepancies arise demonstrates a lack of due diligence and a potential disregard for the complexity of the valuation process. Professionals should approach such situations by first understanding the specific regulatory requirements for valuation in their jurisdiction. They must then conduct a comprehensive review of both EV and AV calculations, meticulously documenting all assumptions and methodologies. Any material differences should be investigated to understand their root causes. A reconciliation process involving discussion and agreement among relevant parties, e.g., actuaries, finance teams, auditors, is crucial. The final valuation presented must be supported by a clear, well-articulated rationale that addresses any divergences and aligns with regulatory expectations and ethical principles of accuracy and transparency. Question 9. System analysis indicates that an insurance corporation is exploring the integration of advanced artificial intelligence, AI, and machine learning, ML models to enhance its underwriting and claims processing functions. The primary objective is to leverage these technologies for improved efficiency, accuracy, and cost reduction. Considering the regulatory framework and best practices for corporate management in the insurance sector, which of the following approaches best ensures responsible and compliant implementation of AI/ML? Option A. Focusing exclusively on the technical capabilities and performance metrics of AI/ML models, assuming that regulatory compliance and ethical consideration will be implicitly met by the advanced nature of the technology. Option B. Developing a comprehensive AI/ML governance framework that includes robust policies for data privacy, bias detection and mitigation, model validation, ongoing monitoring, and clear human oversight, involving cross-functional teams from legal, compliance, actuarial, and IT. Option C. Implementing AI/ML tools with minimal internal oversight, relying primarily on the vendor's assurances of compliance and ethical operation, and focusing internal resources on the technical aspects of integration. Option D. Prioritizing the rapid deployment of AI/ML solutions based on vendor recommendations to achieve immediate cost savings, with a secondary focus on addressing any compliance issues that may arise post-implementation. The correct answer is D. Prioritizing the rapid deployment of AI/ML solutions based on vendor recommendations to achieve immediate cost savings, with a secondary focus on addressing any compliance issues that may arise post-implementation. Explanation. Scenario analysis. This scenario presents a professional challenge due to the rapid integration of artificial intelligence, AI, and machine learning, ML, into insurance operation, particularly in areas like underwriting and claims processing. The core difficulty lies in balancing the potential benefits of AI/ML, such as increased efficiency and accuracy, with the imperative to maintain regulatory compliance, ethical standards, and robust risk management. Specifically, ensuring that AI/ML models do not introduce or exacerbate biases, that their decision-making processes are transparent and auditable, and that customer data is handled securely and ethically are paramount concerns. The dynamic nature of AI/ML development and deployment necessitates a proactive and adaptable approach to governance and oversight. Correct approach analysis. The correct approach involves establishing a comprehensive AI/ML governance framework that prioritizes ethical considerations, regulatory compliance, and robust risk management. This framework should include clear policies for data privacy, bias detection and mitigation, model validation, ongoing monitoring, and human oversight. It necessitates a multidisciplinary team to oversee AI/ML implementation, ensuring that legal, compliance, actuarial, and IT departments are involved. Regulatory justification stems from the need to adhere to principles of fairness, transparency, and accountability, which are foundational to insurance regulation. Ethical justification lies in protecting consumers from discriminatory practices and ensuring that AI/ML is used responsibly. This approach aligns with best practices for responsible AI deployment, aiming to build trust and ensure the long-term sustainability of AI/ML integration. Incorrect approach is analysis, an approach that focuses solely on the potential cost savings and efficiency gains of AI/ML, without adequately addressing the associated risks and regulatory implications, is fundamentally flawed. This oversight can lead to regulatory breaches, reputational damage, and unfair treatment of customers. For instance, neglecting bias detection in underwriting algorithms could result in discriminatory pricing or coverage denials, violating consumer protection laws and ethical principles. Another incorrect approach would be to implement AI/ML solutions without establishing clear lines of accountability and oversight. This can result in a lack of control over model performance, unintended consequences, and an inability to respond effectively to issues. Regulatory failure would occur if the insurer cannot demonstrate adequate governance and risk management processes for its AI/ML systems, potentially leading to fines or sanctions. A third incorrect approach is to rely on vendor-provided AI/ML solutions without conducting thorough due diligence and independent validation. While vendors may offer advanced technology, the insurer remains ultimately responsible for the compliance and ethical implications of its use. Failure to validate models for accuracy, fairness, and compliance with local regulations would be a significant ethical and regulatory lapse. Professional reasoning. Professionals in insurance corporate management must adopt a proactive and holistic approach to AI/ML integration. This involves 1. Understanding the regulatory landscape, staying abreast of all relevant regulations pertaining to data privacy, consumer protection, and AI/ML use in financial services. 2. Conducting thorough risk assessments, identifying potential risks associated with AI/ML, including bias, security vulnerabilities, and operational failures. 3. Developing robust governance frameworks, establishing clear policies, procedures, and oversight mechanisms for AI/ML development, deployment, and monitoring. 4. Fostering a culture of ethical AI, embedding ethical considerations into every stage of the AI/ML lifecycle. 5. Ensuring transparency and explainability, striving for AI/ML models that are understandable and auditable, especially in customer-facing decisions. 6. Prioritizing human oversight, maintaining human involvement in critical decision-making processes, even when AI/ML is used. 7. Continuous learning and adaptation, recognizing that AI/ML technology and regulations are constantly evolving, requiring ongoing review and updates to governance practices. Question 10. The risk matrix shows a heightened risk of misstatement in the valuation of insurance contract liabilities due to the complexity of actuarial assumptions. Which approach best ensures the accuracy and regulatory compliance of the company's financial reporting in this area? Option A. Relying on management's representations regarding the adequacy of actuarial assumptions and the resulting liability estimates. Option B. Conducting a comprehensive review of the company's actuarial methodologies, underlying data, and the reasonableness of key assumptions, comparing them against industry benchmarks and regulatory guidance. Option C. Focusing on the historical accuracy of past reserve estimates without considering current economic conditions or changes in claims patterns. Option D. Applying accounting standards in a manner that smooths reported earnings, even if it requires making more conservative assumptions about future claims. Correct answer is A. Relying on management's representations regarding the adequacy of actuarial assumptions and the resulting liability estimates. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of insurance accounting principles and their application within the specific regulatory framework governing the insurance corporate management exam. The core challenge lies in balancing the need for accurate financial reporting with the potential for management bias or misinterpretation of complex accounting standards. Careful judgment is required to ensure that financial statements reflect the true economic substance of the company's operations and financial position, adhering strictly to the prescribed regulatory environment. The correct approach involves a thorough review of the company's accounting policies and procedures, specifically focusing on the recognition and measurement of insurance contracts and related assets and liabilities. This includes verifying that the methodologies used for estimating reserves, unearned premiums, and claims are consistent with the applicable accounting standards and regulatory guidance. The professional judgment applied here must be objective, well-documented, and supported by sufficient evidence. This approach is correct because it directly addresses the potential risks identified in the risk matrix by ensuring compliance with accounting standards and regulatory requirements, thereby promoting transparency and reliability in financial reporting. Adherence to these principles is ethically mandated and legally required by the regulatory framework for insurance companies. An incorrect approach would be to accept management's assertions regarding the adequacy of reserves without independent verification. This fails to acknowledge the inherent subjectivity in reserve estimation and the potential for management bias, which could lead to misstated financial results. Ethically, this demonstrates a lack of due diligence and professional skepticism. Regulatory failure occurs because it bypasses the scrutiny necessary to ensure compliance with accounting standards and solvency requirements. Another incorrect approach would be to apply accounting standards in a manner that prioritizes short-term profitability over long-term financial stability. This might involve aggressive revenue recognition or underestimation of liabilities. This is ethically problematic as it misleads stakeholders about the company's true financial health. It also represents a significant regulatory failure, as it violates the principles of prudence and conservatism that underpin insurance accounting and solvency regulations. A further incorrect approach would be to focus solely on compliance with the letter of the law, without considering the spirit of the regulations or the economic reality of the transactions. This could lead to technically compliant but misleading financial reporting. Professional reasoning process should involve a systematic evaluation of the identified risks, a thorough understanding of the applicable accounting standards and regulatory requirements, the exercise of professional skepticism, and the documentation of all judgments and decisions. Professionals must always prioritize the integrity and accuracy of financial reporting, ensuring that financial statements provide a true and fair view of the company's performance and position, in line with best practices and regulatory expectations. Question 11. What factors determine the appropriateness of a cloud computing strategy for an insurance company operating under UK regulatory frameworks, specifically concerning the protection of customer data and the maintenance of operational resilience? Option A. The reputation of the cloud service provider within the broader technology sector, irrespective of their specific compliance with financial services regulations or data protection laws applicable in the UK. Option B. The perceived cost-effectiveness and the availability of advanced technological features offered by the cloud service provider, assuming general industry best practices are sufficient for regulatory compliance. Option C. The extent to which the cloud service provider's security certifications and contractual terms align with UK GDPR, FCA, and PRA requirements for data protection, data residency, auditability, and business continuity, alongside a comprehensive risk assessment of the provider's operational resilience and exit strategy. Option D. The speed at which the cloud service provider can migrate the insurance company's data and systems, with a primary focus on minimizing disruption to ongoing business operations, without detailed scrutiny of the provider's specific regulatory adherence. The correct answer is C. The extent to which the cloud service provider's security certifications and contractual terms align with UK GDPR, FCA, and PRA requirements for data protection, data residency, auditability, and business continuity, alongside a comprehensive risk assessment of the provider's operational resilience and exit strategy. Explanation. This scenario is professionally challenging because it requires an insurance company to balance the significant operational and cost benefits of cloud computing with its stringent regulatory obligations concerning data security, privacy, and business continuity. The decision-making process must be grounded in a thorough understanding of the specific regulatory framework governing insurance operations within the relevant jurisdiction, which in this case is assumed to be the UK, adhering to the Financial Conduct Authority, FCA, and Prudential Regulation Authority, PRA guidelines, as well as relevant data protection laws like the UK GDPR. The correct approach involves a comprehensive risk assessment and due diligence process that prioritizes regulatory compliance and customer protection. This means meticulously evaluating potential cloud service providers, CSP, based on their security certifications, data residency capabilities, disaster recovery plans, and contractual terms that align with regulatory requirements for outsourcing and data handling. The focus must be on ensuring that the chosen cloud solution enables the insurer to meet its obligations under the FCA's principles for businesses, particularly Principle 2, Customers' Interests, and Principle 3, Managing Business Soundly, as well as the PRA's Solvency Roman II requirements for operational resilience and data security. Contractual agreements must explicitly address data ownership, access, audit rights, and exit strategies, ensuring the insurer retains ultimate control and can meet regulatory reporting and supervisory demands. An incorrect approach would be to prioritize cost savings or perceived technological advancement over regulatory compliance. For instance, selecting a CSP solely based on the lowest price without adequately assessing their security posture or compliance with UK data protection laws would be a significant regulatory failure. This could lead to breaches of the UK GDPR, resulting in substantial fines and reputational damage. Another incorrect approach would be to assume that CSB's general industry certifications are sufficient without verifying their applicability to the specific sensitive data handled by the insurance company, and ensuring the CSB can meet the insurer's specific regulatory obligations, such as those related to data localization or specific security controls mandated by the FCA or PRA. Failing to establish clear contractual terms regarding data access, audit rights, and business continuity, or not having a robust exit strategy, would also represent a failure to manage operational risk effectively and could impede the insurer's ability to respond to regulatory inquiries or operational disruptions. The professional decision-making process should involve a cross-functional team including IT, legal, compliance, risk management, and business operations. This team should develop a detailed cloud adoption strategy that maps regulatory requirements to technical and operational controls. Before engaging any CSB, a thorough due diligence checklist, informed by regulatory guidance, should be completed. Contract negotiations should be rigorous, ensuring all regulatory and risk mitigation requirements are embedded. Ongoing monitoring and regular reviews of the CSB's performance and compliance are essential to maintain regulatory adherence and operational resilience. Question 12. Examination of the data shows an applicant for a life insurance policy whose occupation is in a sector that has recently faced negative public perception. The underwriting manual provides clear guidelines for assessing the risks associated with this occupation, including specific factors to consider and corresponding premium adjustments. The underwriting manager is aware that some competitors may be hesitant to insure individuals in this sector due to the negative perception, potentially leading to a less competitive market for these applicants. The manager is considering how to proceed with this application. Which of the following approaches best aligns with sound underwriting principles and regulatory requirements for risk selection and pricing? Option A. Accept the applicant at the standard premium rate indicated by the underwriting manual, prioritizing business acquisition over a detailed risk assessment. Option B. Conduct a thorough risk assessment of the applicant based on the underwriting manual's guidelines, applying the appropriate premium adjustments for the identified risks, and documenting the decision. Option C. Accept the applicant but charge a significantly higher premium than indicated by the underwriting manual to compensate for the perceived reputational risk to the insurer. Option D. Reject the applicant outright due to the negative public perception associated with their occupation, regardless of the specific risk factors presented. The correct answer is D. Reject the applicant outright due to the negative public perception associated with their occupation, regardless of the specific risk factors presented. Explanation. This scenario presents a professional challenge because it requires the underwriting manager to balance the insurer's financial sustainability with the ethical imperative of fair and non-discriminatory risk assessment. The manager must navigate the complexities of underwriting guidelines, which are designed to ensure profitability and solvency, while also adhering to regulatory requirements that prohibit unfair discrimination. The pressure to meet profitability targets can create a temptation to deviate from established underwriting principles, making careful judgment and a strong ethical compass essential. The correct approach involves a thorough review of the applicant's risk profile against the insurer's established underwriting manual and pricing guidelines, without introducing subjective biases or external pressures. This approach is correct because it upholds the principles of sound underwriting, which are foundational to the financial health of the insurance company and the protection of policyholders. Specifically, it aligns with regulatory frameworks that mandate objective risk assessment and prohibit discrimination based on factors not directly related to insurability. By adhering to the underwriting manual, the manager ensures that pricing accurately reflects the assessed risk, thereby maintaining the insurer's solvency and its ability to meet future claims. This also prevents adverse selection, where only high-risk individuals seek insurance, potentially destabilizing the market. An incorrect approach would be to reject the applicant solely based on a perceived negative association with their profession, without a detailed risk assessment. This fails to comply with regulations that require underwriting decisions to be based on objective risk factors and can lead to unfair discrimination. It also ignores the possibility that individuals within that profession may have varying risk profiles. Another incorrect approach would be to accept the applicant at a significantly higher premium than indicated by the underwriting manual, simply to mitigate perceived reputational risk or to appease a potentially influential applicant. This practice is ethically questionable as it overcharges the policyholder for risks not demonstrably present and can be seen as a form of unfair pricing. It also undermines the integrity of the underwriting process and the established pricing structure, potentially leading to market distortions. A further incorrect approach would be to accept the applicant at the standard rate without a proper assessment, based on a desire to secure business or maintain a relationship, despite the underwriting manual suggesting a higher risk. This exposes the insurer to potential financial losses if the applicant's risk is indeed higher than average, jeopardizing the insurer's solvency and its ability to fulfill its obligations to all policyholders. It also violates the principle of equitable risk pooling. The professional decision-making process for similar situations should involve a systematic review of the applicant's information against the insurer's underwriting guidelines. If the guidelines are unclear or do not adequately address the specific risk presented, the underwriter should consult with senior underwriting staff or a medical advisor, as appropriate. Decisions must be documented thoroughly, with clear justifications based on objective risk factors and regulatory compliance. Ethical considerations, such as fairness and non-discrimination, should be paramount throughout the process. Question 13. When evaluating the potential impact of evolving environmental regulations on an insurance company's solvency and product offerings, which of the following represents the most prudent and compliant management approach? Option A. Primarily rely on historical claims data to adjust premiums, assuming that past trends will accurately reflect future environmental liabilities under new regulations. Option B. Proactively integrate environmental risk assessment into the enterprise risk management framework, including monitoring emerging regulations, assessing their impact on underwriting and pricing, and investing in relevant expertise and data analytics. Option C. Assign responsibility for monitoring and managing environmental risks solely to the claims department, without broader integration into underwriting or the overall risk management strategy. Option D. Defer significant investment in environmental risk assessment and mitigation until specific, actionable regulatory mandates are issued by supervisory authorities. The correct answer is B. Proactively integrate environmental risk assessment into the enterprise risk management framework, including monitoring emerging regulations, assessing their impact on underwriting and pricing, and investing in relevant expertise and data analytics. Explanation. This scenario presents a significant professional challenge for an insurance corporate management team due to the evolving and increasingly stringent nature of environmental regulations and their direct impact on underwriting, risk assessment, and financial solvency. The challenge lies in proactively identifying, assessing, and integrating these complex, often forward-looking, environmental risks into the core business strategy and operational frameworks, rather than reacting to regulatory changes or claims. Failure to do so can lead to significant financial losses, reputational damage, and regulatory penalties. Careful judgment is required to balance the immediate costs of compliance and adaptation with the long-term benefits of sustainability and risk mitigation. The correct approach involves a comprehensive and proactive integration of environmental risk management into the company's enterprise risk management framework. This includes establishing robust processes for monitoring emerging environmental legislation, assessing their potential impact on existing and future insurance products, and developing appropriate underwriting guidelines and pricing strategies. It also necessitates investing in data analytics and expertise to better understand and quantify environmental liabilities, such as those arising from climate change impacts, e.g., increased frequency and severity of natural disasters or pollution events. This approach aligns with the regulatory expectation for insurers to manage all material risks, including those stemming from environmental factors, and to maintain adequate capital reserves to cover potential claims. It also reflects a commitment to corporate social responsibility and long-term business sustainability, which are increasingly scrutinized by regulators and stakeholders. An incorrect approach that focuses solely on historical claims data for pricing and risk assessment fails to account for the forward-looking nature of environmental regulations and emerging risks. This can lead to underpricing of risks associated with new environmental exposures and inadequate reserves, potentially violating solvency requirements. Another incorrect approach, which is to delay significant investment in environmental risk assessment until specific regulatory mandates are issued, is reactive and exposes the company to greater financial and operational disruption. It also suggests a lack of foresight and a failure to adhere to the spirit of regulatory guidance that encourages proactive risk management. Finally, an approach that delegates environmental risk oversight entirely to a single department without embedding it into the broader framework, and without clear accountability at the board level, is likely to result in fragmented and ineffective risk management, leaving the company vulnerable to unforeseen environmental liabilities. Professionals should adopt a decision-making framework that prioritizes proactive risk identification and integration. This involves establishing cross-functional teams to monitor regulatory developments, conducting regular scenario planning exercises to assess potential impacts of environmental risks, and ensuring that the board of directors has a clear understanding of the company's environmental risk profile and mitigation strategies. Regular training and development for underwriting and risk management staff on environmental issues are also crucial. Question 14. Risk assessment procedures indicate that a competitor has recently launched a new product with a significantly lower premium structure, potentially impacting market share. Which of the following approaches to competitive analysis is most appropriate and compliant with UK insurance regulatory and competition law frameworks? Option A. Launch a public relations campaign highlighting perceived weaknesses in the competitor's new product and questioning its long-term financial stability without concrete evidence. Option B. Conduct a thorough analysis of publicly available information regarding the competitor's product features, target market, and distribution channels, and use this intelligence to refine the firm's own product development and marketing strategies to offer enhanced value to policyholders. Option C. Initiate discussions with the competitor to understand their cost structure and pricing rationale, and subsequently adjust the firm's own pricing strategy to match or undercut their new premium. Option D. Share the firm's upcoming product development roadmap and internal cost projections with the competitor to foster a more stable market environment and avoid aggressive price wars. The correct answer is C. Initiate discussions with the competitor to understand their cost structure and pricing rationale, and subsequently adjust the firm's own pricing strategy to match or undercut their new premium. Explanation: this scenario is professionally challenging because it requires a nuanced understanding of competitive dynamics within the insurance sector, specifically how to interpret and act upon competitive analysis findings without breaching regulatory boundaries or engaging in anti-competitive practices. The core challenge lies in distinguishing between legitimate market intelligence gathering and actions that could be construed as collusion or market manipulation. Careful judgment is required to ensure that competitive analysis informs strategic decisions in a way that benefits policyholders through innovation and efficiency, rather than harming competition. The correct approach involves systematically gathering publicly available information, analyzing market trends, and identifying potential strategic responses to competitor actions that are focused on improving the insurer's own product offerings, service delivery, or operational efficiency. This approach is ethically sound and regulatorily compliant as it focuses on self-improvement and market adaptation. Specifically, under UK insurance regulations, such as those enforced by the Financial Conduct Authority, FCA, firms are expected to understand their market and competitive landscape to ensure they are offering suitable products and services. However, this understanding must be gained through legitimate means, and any resulting strategies must not involve anti-competitive behavior. The FCA's principles for businesses, particularly Principle 7, Communications with Clients, and Principle 8, Utmost Good Faith, indirectly support this by requiring firms to act honestly, fairly, and professionally in accordance with the best interests of their customers. Furthermore, competition law such as the Competition Act 1998 prohibits agreements or concerted practices that prevent, restrict, or distort competition. Therefore, focusing competitive analysis on internal strategy development based on observable market behavior is the only compliant path. An incorrect approach that involves directly sharing pricing strategies or future product development plans with competitors is a clear violation of competition law. Such actions would constitute anti-competitive collusion, aiming to fix prices or limit innovation, thereby harming consumers. This directly contravenes the spirit and letter of competition legislation and would likely lead to severe penalties, including significant fines and reputational damage. Another incorrect approach, which is to use competitive analysis to deliberately undercut competitor prices to the point of unsustainable business practices, could be viewed as predatory pricing. While not always explicitly prohibited in all contexts, it can be investigated under competition law if it is deemed to be an abuse of a dominant position or part of a broader anti-competitive strategy. Ethically, it raises questions about the firm's long-term viability and its commitment to fair market practices, potentially impacting policyholder security if it leads to financial instability. A third incorrect approach, which is to engage in aggressive, unsubstantiated negative marketing campaigns against competitors based on speculative or unverified information, is ethically problematic and can also have regulatory implications. While firms are allowed to highlight their own strengths, deliberately misleading or unfairly disparaging competitors can breach advertising standards and consumer protection regulations, such as those overseen by the Advertising Standards Authority, ASA, and the FCA's principles on fair and clear communications. The professional decision-making process for similar situations should involve a robust internal compliance framework. When conducting competitive analysis, firms should 1. Define clear objectives for the analysis that are focused on understanding market dynamics and improving internal operations. 2. Ensure all data gathering is conducted through legitimate and publicly available sources. 3. Establish strict protocols to prevent any information sharing or discussions with competitors that could be construed as anti-competitive. 4. Regularly train staff on competition law and ethical business practices. 5. Seek legal counsel when there is any doubt about the legality or ethical implications of competitive analysis activities or proposed strategies. Question 15. Operational review demonstrates that the company is facing a significant increase in the potential for large, infrequent claims related to a specific product line due to evolving environmental factors. The company's current capital reserves are adequate for historical claim patterns, but may be insufficient to absorb the financial impact of a severe, low-probability event under these new environmental conditions. Considering the regulatory framework for insurance corporate management, which risk mitigation strategy would be most appropriate to address this evolving exposure while ensuring compliance and financial stability? Option A. Ceasing to underwrite the affected product line entirely and divesting from all related business activities. Option B. Negotiating reinsurance treaties to transfer a portion of the potential large claim exposure to a reinsurer. Option C. Implementing enhanced internal claims processing procedures and investing in advanced weather forecasting technology to better predict and manage claim frequency and severity. Option D. Increasing premiums across all product lines to build a larger general contingency fund. The correct answer is C. Implementing enhanced internal claims processing procedures and investing in advanced weather forecasting technology to better predict and manage claim frequency and severity. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how different risk mitigation strategies align with regulatory expectations for prudent corporate management within the insurance sector. The challenge lies in identifying the most appropriate strategy that not only addresses the identified risk, but also complies with the spirit and letter of the relevant regulations, ensuring the long-term solvency and stability of the insurer. A superficial application of risk management principles without considering the specific regulatory context can lead to non-compliance and potential financial or reputational damage. The correct approach involves a comprehensive assessment of the risk and the selection of a mitigation strategy that is both effective and compliant. Risk transfer in this context is the most appropriate strategy. This involves shifting the financial burden of potential losses to a third party, typically through insurance or reinsurance. Regulatory frameworks for insurance companies often mandate or strongly encourage the use of risk transfer mechanisms to protect policyholders and maintain capital adequacy. By transferring a portion of its underwriting risk, the company can reduce its exposure to catastrophic events or large claims, thereby safeguarding its financial stability and meeting regulatory capital requirements. This aligns with the regulatory objective of ensuring that insurers can meet their obligations to policyholders. An incorrect approach would be to solely focus on risk avoidance without considering the business implications or regulatory feasibility. Avoiding a particular line of business or activity might eliminate the risk. It could also lead to a significant loss of market share or revenue, potentially jeopardizing the company's overall viability. Regulators expect insurers to manage risks prudently, not necessarily to eliminate all potential risks, especially those inherent in core business operations. Another incorrect approach would be to rely solely on risk reduction through internal controls without adequate consideration of the residual risk. While robust internal controls are essential for managing operational risks, they may not be sufficient to mitigate the impact of large, infrequent events. Over-reliance on risk reduction alone, without exploring risk transfer for certain exposures, could leave the company vulnerable to significant financial shocks, potentially leading to solvency issues and regulatory intervention. This fails to meet the regulatory expectation of comprehensive risk management that includes appropriate hedging of significant exposures. The professional decision-making process for similar situations should involve a structured risk assessment framework that identifies, analyzes, and evaluates risks. This should be followed by a strategic selection of mitigation techniques, considering their effectiveness, cost, and crucially, their alignment with the specific regulatory requirements of the insurance industry. Professionals must constantly evaluate the interplay between business objectives, risk appetite, and regulatory obligations to ensure that chosen strategies are both commercially sound and compliant. Question 16. Regulatory review indicates that the current policy administration system is experiencing delays in policy issuance and has a high volume of manual data correction tasks, impacting operational efficiency. Which of the following approaches to process optimization within the policy administration system is most aligned with regulatory expectations for insurance corporate management? Option A. Prioritize the rapid deployment of new customer-facing features, deferring comprehensive data integrity checks to a later phase. Option B. Automate the generation of policy documents without first ensuring the accuracy and completeness of the underlying policy data. Option C. Significantly reduce the number of manual data entry checks to expedite the processing of new policy applications. Option D. Implement automated data validation rules at multiple input points and streamline the workflow for underwriting approvals through enhanced system integration. The correct answer is D. Implement automated data validation rules at multiple input points and streamline the workflow for underwriting approvals through enhanced system integration. Explanation: this scenario is professionally challenging because it requires balancing operational efficiency with the stringent regulatory requirements governing policy administration systems in the insurance industry. The core challenge lies in identifying and implementing process optimizations that enhance speed and reduce costs without compromising data integrity, customer service, or compliance with regulatory mandates. Careful judgment is required to distinguish between superficial improvements and those that genuinely strengthen the system's adherence to legal and ethical standards. The correct approach involves a systematic review and enhancement of existing workflows within the policy administration system, focusing on automation of routine tasks, streamlining data entry and validation, and improving communication channels between different system modules and departments. This approach is right because it directly addresses the need for efficiency while ensuring that all changes are vetted against regulatory requirements. Specifically, it aligns with the principles of good governance and operational resilience mandated by insurance regulators, which emphasize the importance of accurate record keeping, timely policy processing, and robust data security. By automating tasks and improving data flow, the system becomes more reliable and less prone to errors, thereby reducing the risk of regulatory breaches related to misrepresentation, incorrect premium calculations, or delayed claims processing. This proactive optimization also supports the insurer's duty of care to policyholders. An incorrect approach that focuses solely on reducing the number of manual checks without a corresponding increase in automated validation is professionally unacceptable. This failure stems from a disregard for regulatory requirements that mandate accuracy and prevent fraud. Removing essential checks without adequate automated safeguards increases the risk of errors entering the system, which can lead to financial losses for the insurer and misstatements to policyholders, potentially violating consumer protection laws. Another incorrect approach that prioritizes speed of policy issuance over thoroughness of underwriting and data verification is also professionally unacceptable. This approach neglects the regulatory imperative for sound underwriting practices, which are designed to ensure that policies are issued appropriately and that the insurer assumes risks it can manage. Rushing the process can lead to the issuance of policies that do not accurately reflect the risk profile of the insured, potentially resulting in adverse selection and financial instability, which are key concerns for regulatory bodies. A third incorrect approach that involves implementing new system features without adequate testing or without considering their impact on existing regulatory compliance measures is professionally unsound. This oversight can introduce new vulnerabilities or inadvertently create noncompliance with existing regulations, such as data privacy laws or solvency requirements. The failure lies in not conducting a comprehensive impact assessment, which is a fundamental aspect of responsible system management and regulatory adherence. The professional decision-making process for similar situations should involve a structured approach. First, thoroughly understand the current regulatory landscape and specific requirements related to policy administration systems. Second, identify areas for potential optimization by analyzing existing workflows, performance metrics, and identified pain points. Third, evaluate proposed optimizations against regulatory requirements, data integrity standards, and customer impact. Fourth, conduct rigorous testing of any changes before full implementation. Finally, establish ongoing monitoring and review mechanisms to ensure continued compliance and identify further opportunities for improvement. Question 17. The control framework reveals that the investment committee has proposed a new strategy aiming for significantly higher returns by increasing exposure to higher-risk, illiquid assets. As a senior corporate manager responsible for ensuring the insurer's solvency and adherence to regulatory capital requirements, how should you evaluate and respond to this proposal? Option A. Reject the strategy immediately due to the inherent increase in risk, without further detailed analysis, to maintain a conservative investment posture. Option B. Approve the strategy, provided a detailed risk assessment is conducted and the potential returns are clearly communicated to the board, while ensuring ongoing monitoring of market conditions. Option C. Delegate the final decision to the investment committee, trusting their expertise to balance risk and return within the company's stated risk appetite. Option D. Approve the strategy only if it demonstrably enhances the insurer's ability to meet its immediate operational expenses and short-term liabilities, irrespective of long-term solvency implications. The correct answer is B. Approve the strategy, provided a detailed risk assessment is conducted and the potential returns are clearly communicated to the board, while ensuring ongoing monitoring of market conditions. Explanation. This scenario presents a professional challenge because it requires a senior manager to balance the immediate financial pressures of the company with the long-term solvency and policyholder protection obligations mandated by regulatory bodies. The temptation to prioritize short-term gains through aggressive investment strategies, even if they carry higher risk, can be significant when facing performance targets. However, the core duty of an insurance corporate manager is to ensure the company's ability to meet its future obligations to policyholders, which is directly tied to prudent risk management and capital adequacy. The correct approach involves a thorough assessment of the proposed investment strategy's alignment with the company's risk appetite, capital requirements, and solvency margins, as defined by the relevant regulatory framework. This includes understanding the potential impact of market volatility on the investment portfolio, and ensuring that sufficient liquid assets are maintained to cover claims and operational expenses. Regulatory guidelines, such as those pertaining to capital adequacy ratios and investment restrictions, are paramount. The manager must ensure that any investment decision does not jeopardize the company's financial stability or its capacity to fulfill its contractual promises to policyholders. This aligns with the overarching objective of protecting policyholders and maintaining market confidence, which are fundamental tenets of insurance regulation. An incorrect approach would be to approve the investment strategy solely based on the potential for higher returns, without adequately considering the associated risks and their implications for solvency. This could lead to a breach of regulatory capital requirements, potentially triggering supervisory intervention and harming policyholder interests. Another incorrect approach would be to dismiss the strategy outright without a proper risk assessment, as this might stifle innovation and prevent the company from achieving competitive returns that could benefit policyholders in the long run. A third incorrect approach would be to delegate the decision entirely to the investment team without sufficient oversight or independent validation of the risk assessment, thereby abdicating managerial responsibility for ensuring regulatory compliance and prudent financial management. Professionals should adopt a decision-making framework that prioritizes regulatory compliance and policyholder protection. This involves a structured risk assessment process, clear communication with the board and relevant committees, and a commitment to understanding the long-term implications of financial decisions. When faced with proposals that could impact solvency, a manager should always err on the side of caution, seeking expert advice and ensuring that all decisions are defensible under the relevant regulatory framework. Question 18. The performance metrics show a decline in market share and an increase in operational costs over the last 2 fiscal periods. The executive team is tasked with developing a revised strategic plan to address these trends. Which of the following approaches best aligns with a robust and compliant strategic planning process for an insurance corporation? Option A. Conduct a comprehensive SWOT analysis to identify internal strengths and weaknesses, and then apply Porter's 5 forces model to analyze the external competitive environment, using these insights to formulate strategic objectives and action plans. Option B. Rely on historical performance data and industry best practices to set ambitious growth targets, assuming market conditions will remain favorable. Option C. Focus exclusively on identifying internal operational inefficiencies and implementing cost-cutting measures to improve profitability without further external market analysis. Option D. Prioritize the development of new product lines based on perceived market demand, without a formal analysis of competitive threats or the company's current competitive position. The correct answer is A. Conduct a comprehensive SWOT analysis to identify internal strengths and weaknesses, and then apply Porter's 5 forces model to analyze the external competitive environment, using these insights to formulate strategic objectives and action plans. Explanation. This scenario presents a common challenge in corporate management, translating broad strategic objectives into actionable plans that address specific market realities and internal capabilities. The professional challenge lies in ensuring that the strategic planning process is not merely an academic exercise, but a robust framework that guides decision-making and resource allocation, ultimately leading to improved performance and compliance. The need for deep analysis stems from the potential for misinterpretation of data, leading to flawed strategies that could expose the company to regulatory scrutiny or competitive disadvantage. The correct approach involves a systematic and integrated application of strategic analysis tools, such as SWOT and Porter's 5 forces, to inform the development of specific, measurable, achievable, relevant, and time-bound, SMART objectives. This approach ensures that strategic decisions are grounded in a thorough understanding of the company's internal strengths and weaknesses, as well as external opportunities and threats. Regulatory compliance is inherently linked to sound strategic planning. For instance, understanding competitive forces might reveal areas where market dominance could lead to antitrust concerns, or identifying weaknesses might highlight the need for enhanced risk management frameworks, aligning with prudential regulation. Ethical considerations are also paramount, ensuring that strategies do not lead to unfair market practices or exploitation. An incorrect approach would be to focus solely on internal operational efficiencies without considering the broader competitive landscape or external market dynamics. This failure to conduct a comprehensive external analysis, such as neglecting Porter's 5 forces, could lead to strategies that are easily disrupted by competitors or market shifts, potentially resulting in financial instability that could trigger regulatory intervention. Another incorrect approach would be to develop strategies based on anecdotal evidence or personal biases rather than data-driven analysis. This lack of rigor undermines the credibility of the strategic plan and increases the risk of making decisions that are not in the best interest of stakeholders or that contravene regulatory expectations for due diligence and prudent management. Professionals should adopt a decision-making process that prioritizes a holistic view of the business environment. This involves 1. Data gathering and analysis, systematically collecting both internal and external data. 2. Strategic framework application, utilizing tools like SWOT and Porter's 5 forces to interpret the data and identify key strategic issues. 3. Objective setting, translating insights into smart objectives. 4. Action planning, developing concrete initiatives to achieve objectives. 5. Monitoring and review, continuously tracking progress and adapting the strategy as needed. This iterative process ensures that strategic planning remains dynamic and responsive to evolving circumstances, thereby fostering both business success and regulatory adherence. Question 19. Strategic planning requires the insurance company to explore expanding its reinsurance program to enhance its risk-bearing capacity. The management team is considering several options for new reinsurance partners and structures, some of which involve complex cross-border arrangements. What is the most appropriate approach to ensure compliance with the relevant regulatory framework for reinsurance? Option A. Conduct thorough due diligence on each potential reinsurer and reinsurance structure. Proactively engage with the local regulator to clarify any compliance concerns, and ensure all proposed arrangements demonstrably meet the specific regulatory requirements of the jurisdiction. Option B. Proceed with the chosen reinsurance arrangements based on the advice of external legal counsel specializing in international insurance law, without necessarily seeking direct confirmation from the local regulatory authority. Option C. Implement the reinsurance program first to gain operational experience, and then address any potential regulatory issues that may arise during subsequent reviews or audits. Option D. Prioritize reinsurance arrangements that offer the most competitive pricing and broadest coverage, assuming that reputable international reinsurers operate within acceptable regulatory standards globally. The correct answer is D. Prioritize reinsurance arrangements that offer the most competitive pricing and broadest coverage, assuming that reputable international reinsurers operate within acceptable regulatory standards globally. Explanation. This scenario presents a professional challenge because it requires a senior management team to balance the strategic imperative of expanding market reach with the stringent regulatory obligations surrounding reinsurance. The core difficulty lies in ensuring that the chosen reinsurance partners and structures not only meet the company's risk transfer objectives, but also comply with the specific prudential requirements of the relevant jurisdiction, which are designed to protect policyholders and maintain financial stability within the insurance sector. A failure to adequately assess and manage these regulatory aspects can lead to significant financial penalties, reputational damage, and even the suspension of business operations. The correct approach involves a proactive and thorough due diligence process that integrates regulatory compliance from the outset of strategic planning. This means actively engaging with the regulator, seeking clarification on any ambiguous requirements, and ensuring that all proposed reinsurance arrangements are demonstrably compliant with the spirit and letter of the law. This approach is correct because it prioritizes the long-term viability and integrity of the company by embedding regulatory adherence into its core business strategy. It reflects a commitment to responsible corporate governance and a robust understanding of the legal and supervisory framework governing reinsurance activities, thereby safeguarding the company and its policyholders. An incorrect approach would be to proceed with reinsurance arrangements based solely on perceived cost-effectiveness or the perceived expertise of the reinsurer, without independently verifying their regulatory standing and the compliance of the proposed structure with local regulations. Failure to conduct adequate due diligence and seek regulatory guidance is a significant ethical and regulatory lapse. It demonstrates a disregard for the supervisory framework, potentially exposing the company to undue risk and noncompliance. Another incorrect approach is to assume that a reinsurer's established reputation in other markets automatically guarantees compliance in the current jurisdiction. Regulations are jurisdiction-specific, and what is permissible or standard elsewhere may not be so locally. This assumption can lead to the adoption of noncompliant structures or practices, resulting in regulatory sanctions. A third incorrect approach is to delay seeking regulatory approval or to present a fait accompli to the regulator, hoping for retroactive acceptance. This undermines the principle of proactive supervision and can be viewed as an attempt to circumvent regulatory oversight, leading to severe consequences. Professionals should adopt a decision-making framework that prioritizes regulatory compliance as a foundational element of strategic initiatives. This involves a multidisciplinary approach, bringing together legal, compliance, risk management, and business development teams. The process should include 1. Early engagement with the regulator to understand expectations and potential pitfalls. 2. Comprehensive due diligence on potential reinsurers, focusing on their financial strength, regulatory history, and the compliance of proposed structures within the specific jurisdiction. 3. Internal legal and compliance review to ensure alignment with all applicable laws and guidelines. 4. Documentation of the entire process, including risk assessments and mitigation strategies. Question 20. Research into the tax implications of a UK-domiciled insurance company's investment portfolio, which includes both UK equities and overseas bonds, reveals several potential strategies for managing its tax liabilities. The company's management is seeking to understand the most compliant and effective method for accounting for its investment income and capital gains for tax purposes, considering the specific tax legislation applicable to UK insurance companies. Option A. Primarily focusing on the taxation of investment income under general UK corporate tax rules, with a secondary consideration for any specific exemptions available for insurance companies without detailed examination of the income tax, life assurance business, regulations. Option B. Applying the principles of the UK's Corporate Tax Act 2010, focusing on the taxation of trading profits and capital gains, while separately considering the tax treatment of life insurance company specific reserves and reliefs as outlined in the income tax, life assurance business, regulations. Option C. Treating all investment income and capital gains as part of the company's general taxable profits, applying standard corporate tax rates without specific regard to the unique tax treatments afforded to insurance companies' investment activities or their reserves. Option D. Prioritizing the tax treatment of overseas bond interest based on the tax treaties of the countries of origin, without fully integrating this with the UK's specific taxation framework for insurance companies' investment income and capital gains. The correct answer is B. Applying the principles of the UK's Corporate Tax Act 2010, focusing on the taxation of trading profits and capital gains, while separately considering the tax treatment of life insurance company specific reserves and reliefs as outlined in the income tax, life assurance business, regulations. Explanation. This scenario is professionally challenging because it requires a nuanced understanding of how different tax regimes interact with the unique financial structures of insurance companies. The core difficulty lies in identifying and correctly applying the relevant tax provisions without inadvertently creating unintended tax liabilities or missing opportunities for legitimate tax optimization. Insurance companies operate under specific regulatory frameworks that influence their financial reporting and, consequently, their tax treatment. Failure to accurately interpret these interactions can lead to significant financial penalties, reputational damage, and a loss of investor confidence. The correct approach involves a thorough review of the company's financial statements, specifically focusing on the treatment of reserves, premiums, and investment income, and then cross-referencing these with the applicable tax legislation for insurance companies. This ensures that all income is recognized and taxed appropriately, and that all allowable deductions and reliefs are claimed. The regulatory justification stems from the principle of tax compliance, which mandates that companies accurately report their tax liabilities according to the law. Ethically, it upholds the duty of care to the company and its stakeholders by ensuring financial integrity and responsible tax management. An incorrect approach that focuses solely on general corporate tax principles without considering the specific provisions for insurers would fail to account for unique deductions or treatments of reserves, potentially leading to overtaxation. This violates the principle of tax compliance. Another incorrect approach that prioritizes aggressive tax planning without a clear basis in legislation risks misinterpreting tax laws, which could result in penalties for tax evasion or aggressive tax avoidance. This breaches the duty to act within legal and ethical boundaries. A third incorrect approach that neglects the impact of international tax treaties on cross-border investments would lead to double taxation or failure to claim foreign tax credits, again demonstrating a lack of due diligence and compliance. Professionals should approach such situations by first identifying the specific tax jurisdiction governing the insurance company. They must then consult the relevant tax legislation, including any specific sections pertaining to insurance companies and relevant guidance from tax authorities. A comprehensive review of the company's financial operations and accounting policies is essential to map these to the tax requirements. Finally, seeking expert advice from tax specialists experienced in insurance taxation is a prudent step to ensure accuracy and compliance.